Hey guys, how's it going? It's Andy from Magoo Investing. Today I'm going to be talking about IPOs and more specifically why I think that you should kind of avoid them in their infancy. And so the reason I'm talking about this is because LYFT has kind of been in the news recently. I think it went public around 2 weeks ago and it was going to go public at $72. And I saw that and $72, I'm like, well, I can buy a couple shares of that, put in like 150, 200 bucks and be okay with that. And so I remember texting my dad saying, hey, you know what? I'm thinking about buying some shares of LYFT. It's a company that I care about a little bit, and I'd be okay owning it. And he said, and really stuck with me, he said, if you can't get out in the first like 30 minutes or an hour, you should really avoid being in there. And so I ended up not buying into it, which was great because it originally, or when it went live, it was in the $80 range. And now I believe it's down in the 50s. So I saved a decent amount of money by not making that trade. And so I did some research, and now I'm going to kind of tell you why you should avoid IPOs at the very beginning, because I almost made that mistake, and if I didn't have my dad there, I would have made that mistake, and maybe you can avoid that as well. So in the past couple months, there's kind of been this race between Lyft and Uber to see which one was going to be the first one to go public. And going public is important because it raises funds. And kind of similar to Amazon from what I've seen is that these companies are not very profitable. So they've kind of set up their base, and now they're going to go public to start raising some more money. And so it seemed like Uber was going to be the first one to go public, and then one day it came out that Lyft was going first, so that happened. Uber's getting close and will probably be there in the next month or so. But Lyft said they were going to go public at $72, and $72 doesn't really mean anything. And one of the reasons why I think you should stay away from IPOs is the past numbers, the past prices are kind of a way of you to look to see if you're getting a good deal or not. $72 doesn't mean anything. You have no data to go on to back if that's a good spot to buy or a bad spot. And so everything that goes into it is hype. And I talk a lot about my trading strategy, which is buying after stocks have a bad news event or bad earnings, because you're getting them at a great price. And this is kind of the opposite of that, because I like buying when everyone else is selling. And this is people are excited about something and the hype pushes things up. And when hype comes in, you get the guys that are day trading it. So they'll go in, they'll buy the shares, they'll hold it for a couple minutes and then sell them, and then the stock price falls, which is exactly what happened. It started in the 80s, and then over the past 2 weeks, it's now down in the 50s. So it's steadily been going down ever since it went public. And so I didn't make that mistake, thank goodness, and I put some money elsewhere. But yeah, IPOs are super risky. It's all about hype. You have these companies that you know and love, and then you see that, oh, they're going public. Stuff like Snapchat recently, which is one of the ones that I was kind of paying attention to, and now Lyft, and eventually when Uber goes public. And so people my age see those companies, they're like, oh, I love that company, like I'll buy some shares. And they don't realize that the big investors are going in and they're shorting the company, because you have all these guys that want shares, and then they get them, stock price jumps, and then they just sell everything immediately. And so there's a lot of volatility in the first couple weeks. And I probably wouldn't recommend buying an IPO for maybe 6 months. And the reason of that is I didn't know about this until I did some further research, is that when a stock goes public, a lot of the employees of the company get shares. And that's kind of a thank you for working for them and a reward. And so there are rules put in by the SEC on when you can sell those. And so up until that point that you can sell them, you're going to have to hold on to them. And I believe that the minimum is 90 days. So 90 days from an IPO, they can't do anything about that. So a lot of the shares that are given out that aren't in the free area that people can buy are being held in employees, and they can't do anything. And then once you hit between 90 days or however long, I think it'd be up to like 2 years, you can sell those. And a lot of times people will go and liquidate those shares to get the cash to move it somewhere else. And it's not because, oh, they don't believe in their company anymore. It's they were just giving a lot of money, and they're trying to put that in somewhere that they feel more comfortable. Whether that's buying a house, buying something else, buying a different stock, they're trying to move that out of the IPO that's still pretty volatile. So I think Lyft is a great company. I think Uber is an even better company, so I'm going to be waiting for them personally. But after what I've learned and just kind of seeing how the stock's been moving, I probably won't be touching those until probably the end of this year. So I almost made this mistake, and I'm hoping that you guys will stop and don't get caught in the hype. You can wait. You can buy the stock a year from now, and it'll probably be the same price. things are crazy, and just kind of take things slow. This is a long game, and getting excited about a company that you enjoy and then making a bad decision and then kind of putting yourself at a disadvantage is not worth it. So felt good to be making a video again, trying to be more active now that I have some more free time, not taking as many classes, and I just need to find a job so I can buy more shares of stocks. So hopefully you guys enjoyed this video, and I'll see you guys in the next video.